How's it going, everyone? It's Sam. I want to go over the 2 monthly dividend paying stocks that I own right now, and I want to go through some of the benefits, some of the negatives of having these stocks, and each one in particular. One is an index and one is one individual stock. So I'm going to go through those. I'm going to see if it makes sense for you to own it, whether you are just starting out on your journey or whether you are trying to replace your day job and you're right towards the end and you want some stable income. We'll take a look at that. But first of all, I want to say thank you to all the new subscribers, especially over the last few days. I've been growing like crazy, and actually yesterday I came out with a video on what I was buying in the stock market, and one of these stocks I'm talking about today was in there. I think I showed 653 subscribers, and that was partway through the day. I actually recorded that back on Tuesday because I was going to release it Wednesday. I'm recording this on Wednesday, releasing it Thursday. And my channel has grown so much since then. Just for reference, in that video it's at 658 subscribers, and right now I'm sitting at 783. So I've grown 115 just in the last day, less than a day because it's about 11 a.m. here. And I don't know what it will be at when you guys see it, hopefully over 800, but I'm just having a hard time even keeping up with it because I'm investing $5 more for each new subscriber. So I plan on coming out with a video tomorrow on what I'm buying again for the 750 sub special, but we blew past that. So by then maybe we'll be at 1,000 subs, I don't know. So we'll see how that goes when I buy the stocks. I want to buy them in the next week or two, but I don't want to invest multiple thousands of dollars at one time. I want to do more like $500 to $1,000 at a time. So be on the lookout for that. And if you haven't subscribed, please subscribe. I can see about 87% of people that are watching my channel right now aren't subscribed. So definitely hit that subscribe button, hit the like button. It helps out the channel. And if you've already seen multiple videos, then maybe you want to keep on watching them because I'm going to keep on producing these types of videos. And then just before we start too, I am actually going back to work. So I was sent home a while ago because of a medical condition, and I think I am a frontline worker. So I was sent home, so I've been having a lot of time to make these videos. I still plan on making one video a day for the foreseeable future. So my time's gonna be a little bit packed, but I will do my best going forward. But let's get right into the video here. So the first stock that is the monthly dividend payer is SPHD. Now, SPHD is used by a lot of people, especially if you're trying to replace your income, whether you want just stable income because maybe you're young like me and you just want to use those dividends to reinvest in other companies, or whether you are getting closer to retirement and you want something that will pay you 5% every month, getting a dividend in your account. So regardless of who you are, you can take a look at SPHD. And that stands for the Invesco S&P 500 High Dividend Low Volatility Portfolio ETF. So if you haven't heard about them, they are an index fund that takes the top 75 highest dividend companies out of the S&P 500, so out of the Standard & Poor's 500 largest companies in the United States, and they take the highest 75 dividend payers, and then they weed out 25 of those, so they get rid of 25 that are the most volatile. So what you're left with are the stocks that hold their value the most, so they don't fluctuate in price that much, and pay the best dividends. So it's supposed to be kind of a retirement device to stabilize your income. And as you can see here, it was at about $45 a share. It dropped down to $25 a share. So it dropped 40%. And then it's come back up to about $35. So it's come up a lot, but when you look, it was down to about the price that it started at 7 years ago. But now it's back to $35. I hold this stock myself. I hold both these stocks actually today. I have a large position relative to the portfolio in my Robinhood account. I have about $600 worth, and it's a $2,200 account. And I know that I'm young. A lot of people say that if you're young, you shouldn't hold on to these. But I think that it's fine in a well-diversified portfolio. They have 50 different holdings, like I said. And actually it's 51. They might hold like a cash amount in here, or they might have one company that they're taking out and putting in a different one. But they are well diversified. They have about 3% at the high end in each of these companies, and then it goes down from there. They have companies like Altria Group, which if you don't know about them, they are a tobacco company, but they also invest in alcohol and weed, and then also in nicotine patches. So they're well diversified through those kinds of companies. Iron Mountain, which is a storage facility stock, they store physical files. You have companies like Williams Company, which is a utility company. They have just a lot of different high dividend paying stocks, obviously, but they are really into real estate and utilities and consumer defensive and financials. Those are really some of the really high paying sectors in the S&P 500, and they have a solid dividend history. It says dividend growth of 2 years, but if we look here at their chart, they've been pretty much growing it every year. It's just that this year they went down a little bit, but they've been able to grow it since the beginning pretty sizably. Over the 7 years that they've paid dividends, and since they've been open, they've paid about $9.50 of dividends. So if you bought in at $25 and you got $9.50 worth of dividends, that's about 40% back in dividends in 7 years. And right now, they are paying about a 5.4% dividend yield, which is pretty attractive, and they've been growing this too. And it is pretty nice to see your monthly dividends come in. Now, there are a couple risks to holding this, and I want to hit on these because it's not all good and light here. With SPHD, I see two main risks. One is they aren't really well diversified into some of these sectors that have a really good growth. So they're in real estate, they're in utilities, they're in some of these different sectors that maybe aren't going to expand as quickly as tech, for example. But you don't hold SPHD to get that massive price appreciation. If you want to do that, you'd invest in companies like Facebook and Tesla. So that is one thing. But the other point that a lot of people make is that they have a high expense ratio. So financial advisors will often charge about 1% to 2%. A lot of mutual funds will charge between 1% and 2%. So if you have $100,000 invested, you might have to pay $1,000 to $2,000 a year. SPHD has a much smaller percentage than that for their expense ratio. It's about 0.3%. So on $100,000, you'd have to pay about $300 throughout the year. So that can hurt if you have a large position in them. But I also think that compared to something like a financial advisor, it's very small. It seems like a lot because we're used to zero expense ratios if we invest in our own stocks. But you could essentially recreate this portfolio if you want to go through and rebalance it all the time. But I think that if this is just a small part of your portfolio, you don't really have to worry about the expense ratio. Let's say you own 10% of your portfolio in here and you have a $100,000 portfolio. That's $30 throughout the year. So it's not really that big of a deal, I think, when you break it down like that. So before we go any further, if you don't mind going down there and hitting the like button and the subscribe button, that really helps out the channel. And if you want some free stocks, there are free links to WeBull down there. If you deposit $100, you don't even have to invest it if you don't want. You get 2 free stocks and I get 2 free stocks. And actually, I've been getting some nice stocks, the Levi stocks, which are about $14 a piece. So I've been getting about $28 per referral. So you might be able to get that too. And I appreciate it, guys. I'll let you get back to the video. The other stock that I want to talk about is actually Realty Income. So they are a company that I have and I am very excited about buying. I just bought some of them yesterday, but they are known as the monthly dividend company. So they are a REIT, but before we look at the company on Seeking Alpha, I want to look at this article produced by The Motley Fool just a few days ago on June 2. And it's looking at the company just in general, and I think that they put this in really clear words, and I think that they will be able to explain it really well here. So Realty Income is one of the best known triple net lease operators. So it specializes in standalone triple net leases, which means the tenant is responsible for ongoing property expenses like real estate taxes, maintenance, and building insurance on top of paying for utilities and rent. Triple net leases also tend to be longer term leases. So the companies that rent from Realty Income have to pay for essentially all the expenses, and they also have to pay rent. So it's really hands-off for Realty Income. The other thing is they are very long leases, and I don't know if they hit on here, but they're typically between 10 and 15-year leases. So that really stabilizes the company. It does say that triple net leases are low risk to the REIT, but the rents are typically lower, and that makes sense. They're not having to pay for as much. They don't have to do as much ongoing maintenance, but then you don't have to have some of the staffing that you would need to hire that maintenance out. The other point that they hit on is that Realty Income collected 83% of contracted rent, which was somewhat expected because they have really good tenants. They have investment grade tenants. And of the 17% that was not received, the vast majority came from theaters, restaurants, child care centers, health and fitness businesses. So a lot of the companies that just don't make any money. And what they say here is too, they've been pursuing rent deferrals but not rent abatement. So they're not just letting companies not pay them. They're trying to just let them push it back. They're trying to be flexible. And they've been rejecting some of the requests for deferrals that seem to be mainly opportunistic. The other thing that they hit on here is the top 4 tenants are convenience stores, grocery stores, dollar stores, and drug stores, which are about 37% of revenue. So all those types of businesses are still working right now. They're still having really good numbers right now because of everything that's going on. So that is something that kind of helps them out in the long term. And if you know me or if you know my portfolio, I really like triple net lease companies. I also own IIPR, which is essentially a marijuana REIT, and they are growing a lot too, but they are not monthly dividend payers, so we won't talk about them here today. But Realty Income was about $85 before the crash. It dropped down to about $43, so almost cut in half. Wish I would have bought more, but you can't look back like that. Actually, it got down to $38 on an intraday, and then it's back around $60. It's been going up a lot even since I started buying it. I think I started buying it when it was $50 a share, and it's up about $10 since then. And they also pay monthly dividends. Just looking at their key data here, they've really been able to increase their revenue and their net income over the years. 2015, $1 billion. 2016, $1.1 billion. 17 is $1.2 billion. 18, $1.3, and then 19 about $1.5, and then trailing 12 months, $1.55. So they're constantly bringing their revenues up. With REITs, you have to be a little bit careful because sometimes they will dilute the shares. So the revenues can be a little bit misleading. Let's go down to net income. They've been able to increase this each year too. And let's just go down to earnings per share because that is really the best way of figuring out whether they're really increasing the value to shareholders. And you can see here it's gone up every year but one. And one thing to look at with real estate companies, which I'm not sure I've hit on in the past, is the AFFO. So AFFO is adjusted funds from operations. And I won't go into how you calculate it or why it's used too much, but generally it's just because you can write off some depreciation with real estate. So REITs can be misleading with their net income. So adjusted funds from operation is something that a lot of REITs take into account. You can do some own research too, but they've been able to increase this each year. So that is really a good sign there. And that's something that people really look for in these real estate companies. Now, looking at the dividend, they pay about a 5% dividend, just short of it now. And that's probably going to go down a little bit here today because it's up 5% on the day. But they also pay monthly dividends. They are a dividend aristocrat. So they've been growing their dividend for 26 years. And I don't see them slowing that down here anytime soon because they want to stay on that list, I'm sure. And just looking at their dividend history, since 1996, they've just been growing all the way up. Big jump here from 2012 to 2013, and they've just been steadily increasing. Let's look at their payout ratio. So as a REIT, you generally have to pay out a higher amount towards your dividends. So as you can see here, they have about an 85% payout ratio, which really, as far as REITs go, isn't too bad. So definitely take a look at Realty Income. They are a really stable company that has been around for a really long time with really good tenants. And I don't think they'll be as negatively affected as some of the other REITs that you could invest in right now. So let me know what you guys think below. Are either of these stocks something that you hold in your portfolio? If you want more information on SPHD, Logan Fisher, another financial YouTuber actually from around me here in Michigan, he has a video here on SPHD. and how it pays monthly dividends and how you can use that to replace your income from your job. I'll set up the link below, and I appreciate you guys watching. Let me know what you think down below again, and I will see you in the next video. Thanks.